By learning, you will teach. By teaching, you will learn. A Latin proverb. Hello everyone. I, Dr. Lynette Cristilda, Professor in Commerce, WCC, Chennai, welcome you all to this video on the topic Income from House Property and specifically on determination of annual value of house property. I will be glad to clarify any queries, doubts that you may have. You can reach to me by mail and my mail ID is linetwcc@gmail.com. You can find this on the description box as well. The income from houses, godowns, buildings, bungalows, etc. is to be computed and assessed to tax under the head Income from House Property. We can find the provisions related to it under Section 22 of the Income Tax Act. The house property, when used for assessee's own business, is assessed under income from business or profession and not under his income from house property. There are different types of rental values. ARR, it is the rent received or receivable by the owner of the house property. RRV, sometimes the rent includes the cost of common facilities like lift and pump maintenance, salary of common gardener, watchman, lighting of common stairs and corridors, water and electricity bills. When these costs are reduced from the ARR, it is called RRV. MRV, the values fixed by local authority, that is municipal corporation, which serves as a basis for levying tax, is MRV. FRV, it is a rent prevailing for similar type of house in same or similar locality. Standard rent or SR, it is a rent fixed under the Rent Control Act. ERV, this we will look into when we understand an illustration. These rental values are considered to determine the annual value or the gross annual value or the annual rental value. You can find the format for computing the income from house property, both let out and self-occupied, in this slide. Now we'll move to how the AV or GAV or ARV is determined with an illustration. Case 1. MRV 50,000 per annum, FRV 56,000 per annum, AR 5,000 per month, SR 59,000 per annum, and the house is let out for the full year. The steps include MRV or FRV, whichever is higher. So in this case, 56,000, that is FRV, is the higher amount. This higher amount is compared with the standard rent, which is 59,000. The amount which is lesser, that is 56,000, will be the ERV. Now, the ERV is compared with the ARR, that is the actual rent received. The actual rent is 5,000 per month, which is 60,000 per year. Hence, whichever is higher will be the annual value. With the same information, we shall find out the annual value if the house property is vacant for 2 months. In this case, the steps 1, 2 and 3 will be just the same as the case 1. So, here in the third step, we see that 60,000 is the highest value. When the house is vacant, then there is an additional step, which is the fourth one, wherein the highest amount, that is 60,000, will be reduced by the loss that has occurred to the owner due to the vacancy. Now here in this case, we know that the house is vacant for 2 months and the actual rent is 5,000 per month, which sums up to 10,000 as vacancy. So the annual value will be 60,000 minus 10,000, which is 50,000. Case 3. Same set of information, but when there is unrealized rent of 2 months, then the annual value is calculated in the following way. Here we see the step 1 and step 2 of the case 1 is used here as well. But there is a change in the step 3, which is you need to find what is the ERV, that is here it is 56,000, and then compare it with the ARR minus the URR, which comes to 50,000. After this, you need to compare and find out the ARV. So the basic difference between vacancy and unrealized rent is that in vacancy, the loss due to vacancy is deducted after comparing. But in unrealized rent, the loss due to the unrealized rent is deducted and then it is compared. So there is the difference. So here in this case, the annual value is 56,000. Case 4. Same set of information, but here there is vacancy of 2 months and also unrealized rent of 2 months. In this case also, the steps 1 and 2 are the same. And the third step will be, you will have to imagine and solve the problem as you have done URR. After considering URR, then you need to consider the vacancy. So this is the order. So in this case, 56,000, or you need to reduce the actual rent by the unrealized rent. Now you should note the actual rent should be for the full year. So 60,000 minus unrealized rent of 10,000 will give you 50,000, and here you will compare, and then whichever is less will be reduced by the vacancy, which is 10,000, totally giving you 46,000 as the annual value. So here you need to understand that when there is vacancy given, the vacancy loss will be reduced only after comparing. But when you have unrealized rent, you will reduce and then compare. When you have both vacancy and unrealized rent, first you will reduce the unrealized rent from the actual rent and then you will compare. After you compare, you will reduce the loss due to vacancy. Let's summarize briefly what we have looked at and also note the important provisions under income from house property. Income from house property depends on the annual value of the house and not just on the rent received from the same. Only the owner of the house can be assessed and taxed under income from house property. When the house property is used for assessee's own business or profession, the income received from it is taxable under the head income from business and not under income from house property. In case of dispute about ownership of house, the person who receives rent shall be liable to pay tax. When the quarters is let out to employees of the assessee, the rent so received shall be taxable under the following. If the employee is necessary for the smooth conduct of business or the profession of the assessee, then the rent received from that employee will be taxable under income from business or under profession. Otherwise, it will be taxed under income from house property. Income from subletting will be taxed under income from other sources. Income from hotel or paying guest accommodation will be taxable under income from business. Composite letting of building along with furniture or plant and machinery or any other facility shall be taxed under the following. If the rent is separable with regards to building, then it will be taxed under income from house property. If it is separable to the furniture or plant and machinery, then it is treated under income from other source or income from business. But if the rent is inseparable, then the rent received will be taxed under income from other source or income from business. If the house is purchased or constructed during the previous year, then the rental values, that is MRV, FRV, SR, will be reduced to the period for which it is in existence or owned by the assessee. If the assessee owns more than one self-occupied house, one house shall be treated as self-occupied and the other houses shall be deemed to be let out. If the house is partly let out and partly self-occupied, and if the units are inseparable, then the entire house shall be treated as let out. But if the units are separable, then respective treatment shall apply. If the house is let out for part of the year and self-occupied for remaining part of the year, then the whole house is treated as let out and the actual rent shall be the number of months it is actually let out. This brings me to the end of my presentation. Thanks for your active listening. I'd like to conclude with a quote by B.B. King. The beautiful thing about learning is nobody can take it away from you. Keep learning. Like, share and comment if you find the video useful. Thank you.